Stop the insanity.
John, what's wrong? What's going on here? Why are you invoking Susan Powder? I think was
Susan
her.
Powder. Yeah, exactly. Because look at all these bills and they're all so damn expensive.
Well, that's pretty timely
Why is that?
because this is Queer Money episode 540. And today we are talking about a way that people can save money on healthcare costs using an HSA account.
Well, then let's get on with the show.
Okay.
Capital One Auto Navigator does more than just auto financing. We're here to help you find a car you love, too. Shop millions of cars from thousands of dealers nationwide. Research your favorite makes and models. Explore dealers near you and more. All on Auto Navigator.
So, folks, these are actual bills that we were using as our props for the intro that we actually have been neglecting to open.
No. All of them are recent ones. And actually, one of them is one that I paid, but was an envelope that was sitting around for a while.
So we tend to have a stack of mail that piles up and we ignore until it's too late and then we address it. So the Jeffrey guys and Queer Money podcast hosts aren't as organized as you would think we might be.
It is interesting. I think healthcare is one of those things that a lot of us, especially bills, a lot of us get that deer in the headlights feeling or look when we get one of those bills and we're just like, oh, I'm going to ignore this.
Well, my problem with healthcare bills is that you go to the doctor once and you get like, over the next 6 months, you get like 25 different bills. Some are large and some are small, and you just don't know when you're done paying for that one damn visit. Right. That's a whole other topic. Today, we're talking about HSA accounts, which are some of my most favorite tools out there, and we're going to talk a little bit here about why.
Yeah, exactly. So what is an HSA? An HSA is a health savings account. Wow, and it helps you do exactly that. It helps you save for healthcare expenses. And one of the great things is that a health savings account actually can help you reduce your healthcare costs. One of the reasons why it can help you reduce your healthcare costs is no, they don't negotiate and bring down your healthcare, the medical expenses. What happens is a health savings account can be invested, kind of like an IRA or any investing account. So the money that you put into it can grow, and that can be used to cover your healthcare expenses. So I think
that grows tax-free.
It does, and we'll talk about that a little bit later. But I think that's one of the great things about healthcare or health savings accounts is it does shift, or it can shift, as long as you're investing in one. It can shift the cost of your healthcare away from your daily expenses to being covered by the growth in the market. So
and it kind of also helps you reduce your net life expenses, right? Because contributions can be reduced, can reduce your taxable consequences for that particular year.
Yeah, exactly. There's a couple of other great things, or the reasons why we really like HSAs, is that unlike some other vehicles that you can use for covering medical expenses, they don't expire. You can keep the money in the account until the day you die if you want. It will always be there. And the other nice thing is it rolls over every year, and you can take it wherever you go. So most people sign up for an HSA through their employer. That's what we had. That's how we started ours. You can sign up through your employer, and some employers actually contribute to your HSAs for you. We're the beneficiaries of that. But if you move from one employer to the next, or you move from an employer to being self-employed, or you retire, that money goes with you. Unlike some 401ks or 403bs, if the money wasn't vested, if you hadn't been there for long enough, then the money gets clawed back by your employer. That is not the case with HSA.
And that's one of the reasons I love it, because I don't know, when was the last time? I haven't worked for somebody else since 2014.
Slacker.
I know, right? But I still have...
He's 16.
2016. I still have money in my HSA account that still covers some of my expenses. And you go to the doctors, or you have some medical issue, and you're like just dreading having to pay for it, and you don't want to have to reduce your expenses, take it out of your emergency savings or some other account.
On a credit card.
And I always think to myself, oh, I've got this HSA account. This money is designed to pay for these services or these products, and it feels like it's not really as much of a loss as if it were coming out of our savings account.
Right. So who can use one?
Well, there are two qualifiers for an HSA account. One is you have to be a U.S. taxpayer. So that doesn't necessarily mean you have to be a U.S. citizen, right? You're just a U.S.
Right.
taxpayer. So if you're paying into the U.S. Tax system, even if you are a foreign exchange student or you're temporarily living in the United States for whatever reason, for work or whatever,
visa, right.
you can still, if you're paying taxes, you can still open an HSA account. Then the other qualifier is that you must be enrolled in what's called a high deductible health plan, or HDHP.
What's that?
This I'm going to read to you so I make sure I get it right. A high deductible health plan, or HDHP, has lower monthly payments but higher out-of-pocket medical costs or premiums.
Right. So how do you know if your healthcare plan allows you to or qualifies you for the being able to use an HSA, or you have actually a high deductible healthcare plan? Well, in 2024, and this is just for 2024, HSAs, in order to qualify for one, your deductible, or the amount that you pay on a regular basis, oftentimes that either is what we pay monthly, like you and I do, we submit a payment once a month, or if you're working for an employer, they deduct that from your paycheck. The amount that you are paying cannot be, or it needs to be at least $1,600 a year for an individual and $3,200 a year for families, which is basically a little bit less than $150 a month for individuals and a little bit less than $300 a month for families. That's the first qualifier. The second qualifier is that your out-of-pocket expenses cannot exceed $8,050 for the whole year in 2024 for individuals, or $16,100 for families. So there's kind of this sweet spot zone in between what you pay on a monthly basis and what you would pay for the whole year, although they calculate the numbers as whole years.
Exactly. We just have our accountant do it for us because I can't do that kind of accounting math. So we talked about who qualifies. On the flip side, then, who doesn't qualify? How do you know that you absolutely don't qualify for it? One is if you are claimed as a dependent on somebody else's health insurance plan. So if you are still on your mom and dad's health insurance plan.
Leeches. No, I'm just kidding.
You can't. It's the second time you've called people leeches. You don't qualify for a health savings account. You have to wait until you're off your mom and dad's health insurance plan. So if you're still on that plan and you want to qualify for the HSA, you might need to do a cost benefit analysis to see which is actually better for you. You also don't qualify for an HSA account is if you or your spouse are on some other disqualifying plan. And for most people, that's going to be for those who are on Medicare. Mm-hmm. If you're on Medicare, you do not qualify for an HSA account.
Even if it's, so if I was working and you were on Medicare, or the other way around, neither of us would be eligible for an HSA. So this really requires you to talk to your spouse about what kind of healthcare plan or
they have, or you want to have. Yeah.
Right.
And then also you don't qualify if you have a full purpose flex spending account, which is something else that employers also sometimes offer, or a health reimbursement arrangement. If you have either of those, or your spouse has either of those, then you do not qualify for an HSA account. With no fees or minimums and no overdraft fees, banking with Capital One is the easiest decision in the history of decisions. That's banking reimagined. What's in your wallet? Terms apply. See CapitalOne.com/bank for details. Capital One, N.A., member FDIC.
All right, let's talk about some numbers. How much can you, right? How much can you put into a health savings account to save money for healthcare expenses? As an individual, the maximum amount you can put in 2024 is $4,150. As a family, the max you can put in is $8,300. Now, if you're over the age of 55, one or both of you as individuals in the family are over the age of 55, you can contribute an additional $1,000. So not both spouses can contribute, but $1,000 for an individual, or if you're a family, it's an extra $1,000. So each of those numbers would bump up by $1,000.
Okay, so let's talk about some of the costs that can be covered from your HSA account that makes it a little bit less painful to actually have to pay these bills. There are actually dozens and dozens and dozens of thousands and thousands and thousands of expenses that can be covered from an HSA account. Some of the ones that might be more applicable to our audiences: medication, family planning, health insurance premiums, surgery, doctor copays, glasses, contacts, gynecological visits, hearing aid, hospital visits, insulin, and many, many more. So I would just go.
Are you saying that our listeners need hearing aids?
What? What? Didn't hear that.
Maybe some of the people on this podcast need hearing aids. But what it really points out is that there are just almost any sort of medical expense that you can think of
pretty much
would be covered by these savings, which is really good that all of those kinds of expenses are covered, because then people don't have to hunt and peck to see did this, that's one of the things I hate about insurance is you would get your insurance would get submitted and they come back to you and say, well, we don't actually cover that. It's like, what the heck? Why don't you cover that? Well, in this case, almost anything is covered by HSA.
And we'll elaborate on this toward the end as an example, but it's just so much more gratifying, especially as you contribute to your HSA and you've got it invested and it starts to grow and benefit from the stock market gains. It's so much more gratifying to pay for those bills from growth in your HSA account than it is from actually taking it from the actual principal.
Yeah, and in this year, you and I have we've both gone to the eye doctor, gotten new glasses and contacts. Those were covered by HSA. I had a visit to the hospital. Everything so far for that has been covered by HSA or our insurance. So it really has helped us not have the financial burden of having to come up with extra money every month to cover those, because we have been, and as you pointed out, you and I have had our HSA accounts for well over 10 years now and have experienced a lot of growth in those accounts that has helped cover those expenses. And we didn't contribute a ton of money to those.
And we haven't contributed anything since 2016. Yeah. So what are some of the most popular reasons why somebody would have a health savings account, David?
Well, I think probably the biggest thing that most folks benefit from is the idea of the tax advantages. There are three primary tax advantages. The first one is that any money that you as an individual put in, whether that's coming from your paycheck and your employer does it for you, or you as a self-employed individual or somebody who doesn't have access to health care through your employer, if you're contributing to that account, one of these HSA accounts, it actually reduces the amount of money you're going to have to pay taxes on when you do your taxes. We'll give an example of this in a little bit. The other thing is that idea of portability, where you can take the money with you no matter where you're at, whether you move from one employer to another. I think that's one of the other benefits. And the nice thing is all of that, when you move this money, if you move it around, there are no tax implications to moving the money around.
And for many of our listeners who are going to retire abroad or have retired abroad, you can still use your HSA account in other countries to cover your medical expenses. And when you file your U.S. taxes, you can itemize it accordingly.
Yeah, exactly.
So you still get the benefit while you're abroad.
Right. And speaking of retirement, when you take money out of your HSA, it is not taxed. And when you reach retirement age, if you are over the age of 65, any money that you take out of the account, if it's used for medical expenses, you don't pay taxes on it at all. But if it's not used for medical expenses, you pay just earned income you just pay income tax on the money that you take out. Again, we'll share another example of this.
Meaning that if you're over the age of 65 and you use your HSA to help cover your mortgage or groceries or whatever the case may be, you'll pay income tax on that, but you won't pay a 10% penalty like you might otherwise in another type of retirement account.
Yeah, a lot of folks are starting to talk about HSAs as kind of being an additional retirement savings account for you because of the fact that it grows tax-free, and then when you reach the age of 65, you can use that money for whatever, medical expenses or non-medical expenses, without having to pay a penalty. And when you do use it for non-medical expenses, you're only paying income tax on it, just like you would if you're taking money out of a regular IRA account.
Right. So where can you open an HSA account? Well, if you're working for somebody else, you have an employer, especially if you're working for a Fortune 500 company, there's a very good chance you qualify for an HSA through your employer. If your employer does not have one, or you're working for yourself, as David suggested earlier, some places to look at are, of course, Fidelity, Consumers Credit Union, Lively, First Tech Federal Credit Union, and then there's also Lake Michigan Credit Union. Those are just a couple, but same with trying to find out what expenses can be covered with your HSA. Places to open an HSA, maybe just hit Google or ChatGPT and let it do the homework for you.
Ours is actually with Optum Bank, I think is the name of it. And that's the one that when we signed up with our employer, that's where they ended up putting the funds, and that's where we've kept it and have kept it invested.
Yeah. So what's the triple superpower of HSAs?
Well, again, that goes all the way back to the taxes. I think that this is probably the real big benefit of the HSA account. Again, first, it does anything that you contribute, it reduces your taxes for that year in which you're making the contributions. The account is invested or can be invested, and any of the growth that happens in that account, that is tax-free, and any sort of qualified withdrawals from the account are tax-free as well. So here's an example. Let's say you contribute in 2024 $4,150. That would mean that the income that you would report when you do your taxes at the end of the year would be reduced by $4,150. And if you're in the 20% tax bracket, that's almost $800 in taxes that you wouldn't have to be paying. If you invested that $4,150 in 2015, I'm sorry, in
2015,
David, 2024, and it grew for 20 years, and it grew to be let's just say $16,000, you don't have to pay any taxes on that almost $12,000 worth of growth, which is great. And once you are over the age of 65, you can use that $16,000 on qualified medical expenses and not pay any taxes, or on anything like, for example, paying your mortgage. Now, if you were to use $1,000 to pay your mortgage, that $1,000 would be treated as income for you for the year.
Exactly. So for all those reasons, we love HSA accounts. We heart HSA. We'll be right back.
The mission of Queer Money is to financially empower the LGBTQ+ community. Join us in thanking Capital One for supporting that mission. Thank you again for joining us for another episode of the Queer Money Podcast. Of course, get your Queer Money takeaways and the resources that we mentioned in this episode in this week's newsletter. Make sure you subscribe to that by going to queermoneypodcast.com.
Then join us this Thursday when we take a break from our affordable LGBTQ+ friendly city series domestically. And before we start the international series, we're going to kick off How Gays Retire Fabulously, a recurring bonus series that we're going to cover for a while to help more of you retire fabulously. Then join us next Tuesday when we talk with Dr. Lorraine Dean, who's done innumerable studies about the financial impact of having HIV. She's going to come on and talk about what those financial impacts are. So be sure to listen in for that. Meanwhile, have an amazing week.
Bye.